Silver closed at $75.59 on April 10th. 1 year ago, it was $31.17. That is 143% in 12 months. The S&P 500 returned about 18% in all of 2025. Silver outperformed the S&P 500 by a factor of nearly 8 in a single calendar year. And here is what stopped me when I found it. The total value of American retirement accounts hit $49.1 trillion at the end of 2025. That number comes from the Investment Company Institute, published March 2026. 49.1 trillion, and the vast majority of that money holds 0 ounces of any precious metal. Not one, not a fraction of one. Those two realities are sitting next to each other right now. A metal that gained 143% in a year, and a retirement system holding $49 trillion that, by structure, barely acknowledges the metal exists. I should be upfront about something before we go any further. I am not a financial advisor. Nothing in this video is a recommendation to buy silver, buy gold, sell anything, or change your retirement allocation. This is publicly available data, arranged in an order that I think is worth your time. What you do with it is entirely your decision. I was not looking for silver when I found this story. I was looking at retirement fund performance reports. The kind of quarterly PDF nobody reads, and inside one of them was a line that made me stop scrolling. Vanguard's Target Retirement 2025 fund returned about 8.6% last year. According to Vanguard's published fund returns for 2025, that is a perfectly fine number. That is a fund doing what it was designed to do: slow, steady, diversified across stocks and bonds. Nothing wrong with it. In the same 12-month window, gold rose over 60%. Silver rose 143%. The target date fund did its job. But the gap between doing the job and what happened in precious metals is not a rounding error, it is a canyon. Nobody is talking about this at the office. Nobody brings it up at dinner. You check your 401 balance, you see it went up, you close the app. That is the whole ritual. And I get it. That is what the system trained you to do. But here is what I found next, and it gets worse. Evidence 1. The Silver Institute, in a report published February 2026, confirmed that 2026 marks the 6th consecutive annual supply deficit for silver. 6 years in a row where global demand outstripped global supply. The accumulated shortfall between 2021 and 2025 is estimated at roughly 820 million ounces. Total global supply for 2026 is forecast to rise just 1.5% to about 1.05 billion ounces. Demand is not slowing. Industrial fabrication alone accounts for roughly 650 million ounces, driven largely by solar photovoltaics and electronics. The math does not balance. It has not balanced in 6 years. That is not a blip. That is a structural condition. A parking garage losing more cars than it takes in every single day for 6 years. At some point, you stop calling it a busy week and start asking where all the cars went. Evidence 2. Gold's 60% gain in 2025 was its strongest annual performance in over 4 decades. The last time gold moved like that was the late 1970s, during stagflation. Between 1971 and 1980, gold went from $35 an ounce to over $800. That is a 2,200% gain. Silver moved from roughly $1.50 to $49.95 in the same period. The conditions that drove those moves, persistent inflation, slowing growth, weakening dollar, geopolitical instability, are not identical today, but they rhyme. The Federal Reserve is holding rates in the 3.5 to 3.75% range. As of the March 2026 meeting, inflation has been stubborn, and central banks have bought over 1,000 tons of gold per year in 2022, 2023, and 2024. 3 consecutive years above that threshold for the first time on record. The 2025 total came in at 863 tons, lower but still historically elevated. I did not expect this pattern to line up as cleanly as it did. And every institution with a financial stake in your retirement allocation has a structural incentive to keep your money in the products they manage. Target date funds charge expense ratios. Brokerage platforms earn revenue on trades within their ecosystem. Nobody in that chain makes money when your dollars move to a metal sitting in a vault. Evidence 3. Barron's reported in April 2026 on a UBS analysis that outlines a path for gold to reach $5,900 an ounce by late 2026. Goldman Sachs raised its year-end target to $5,400 in January. Wells Fargo went further, $6,100 to $6,300. JP Morgan sees silver averaging $81 an ounce for the full year. These are not Reddit predictions. These are institutional research desks at major banks, publishing price targets that would have sounded fictional 2 years ago. Now, here is the part worth sitting with for a second. A target date fund holding 60% equities and 40% bonds has no mechanism to capture any of this. Zero exposure. If gold goes to $5,900, your target date fund does not move 1 cent in response. If silver holds above 75 for the rest of the year, your 401 balance does not register it. The instrument you are relying on for retirement was not built to participate in this market. That is not a flaw. That is the design. Sometimes you watch a building burn from across the street and realize you left something inside. Not because you forgot, because nobody told you the building was there. Evidence 4. Here is where I started doing the math myself, and this is where it gets personal. Here is a specific scenario. Say someone has $200,000 in a retirement account. All of it in a standard target date fund. Over the past 12 months, that account grew by roughly 8.6%. That is $17,200 in gains. Solid. Now take the same $200,000. Allocate 90%, $180,000, to the same target date fund. Allocate 10%, $20,000, to a vehicle tracking silver. The target date portion returns 8.6%. That is $15,480. The silver portion returns 143%. That is $28,600. Total gains on the blended portfolio, $44,080. Compared to $17,200 on the standard allocation. $15,480 plus $28,600, $44,080 versus $17,200. The difference is $26,880 on a $200,000 portfolio in 1 year from moving 10%. I am not telling you this would happen again. Past performance is exactly that, past. Silver could drop 40% tomorrow. It has done it before. January 1980, silver hit $49.95. By March, it crashed to under $11. That was Silver Thursday. The Hunt brothers learned that lesson so the rest of us wouldn't have to. Except most of us did not learn it either, because nobody taught it. But the calculation is real. The gap is real. And the question of whether a retirement portfolio might have benefited from even a small allocation to precious metals during a year when they outperformed most major asset classes. That question has a number attached to it now. There is a person I want you to think about. Their name is Sage. 34 years old, lives in Columbus, Ohio, works in logistics management, salary $68,000. Has been contributing to a 401 since age 26, current balance $89,000. Credit score 722. Sage has never missed a contribution. Automatic deposit 6% of every paycheck with a 3% employer match. The money goes into a target date 2055 fund. Sage has never logged into the brokerage account to change the allocation, not once in 8 years. Last year, that fund returned about 21%. According to Vanguard's published fund returns for 2025, Sage's balance grew by roughly $18,700. Solid. But in the same 12 months, if just 10% of that $8,900 had been in a silver tracking vehicle, the gain on that slice alone would have been about $12,700 on $8,900. The remaining $80,100 in the target date fund would have returned about $17,200. Combined, that is roughly $29,900 compared to the $18,700 Sage actually got. $11,200 left on the table from moving 10%. Sage did not make a wrong decision. Sage made no decision. And in a year where silver gained 143% and the target date fund gained about 21%, the cost of no decision was about $11,200 in 1 year on 10%. By every measure the system uses, Sage is doing everything right. Contributing early, getting the match, staying consistent. The system's reward for 8 years of perfect behavior was zero exposure to the best performing asset class of the year. Not because Sage chose to avoid it, because the menu never included it. When was the last time you actually logged into your retirement account and looked at what you own? Not the balance, the holdings, the actual funds, the allocation percentages. You probably saw the number, decided it looked okay, and closed the app. You did not scroll down to the part that shows you what is inside the fund. Nobody does. That is the scroll that cost $26,880. Evidence 5. This is the part the system buries in the fine print. The IRS allows precious metals inside retirement accounts. This is not new. Self-directed IRAs can hold physical gold and silver, coins and bars that meet specific purity requirements. Gold must be 99.5% pure. Silver must be 99.9%. The metals must be stored in an IRS-approved depository. You cannot keep them at home. The rules have been on the books for years. But here is the structural barrier. Most employer-sponsored 401 plans do not offer a precious metals option. The menu is set by the plan administrator. You get a list of mutual funds, maybe a brokerage window if you are lucky, and that is it. To access physical metals in a retirement context, most people would need to roll over into a self-directed IRA, which involves paperwork, a custodian, storage fees, and enough initiative to do something the system never prompted you to do. The average annual fee for a gold or silver IRA custodian runs between $150 and $300, depending on the provider and the storage arrangement. The eShares Silver Trust, SLV, charges an expense ratio of 0.50%. On $20,000, that is $100 a year. These are not prohibitive numbers, but they are friction, and friction is how the default wins. The retirement system was not designed to make this easy. It was designed to make the default comfortable. Automatic enrollment, automatic escalation, automatic allocation into a target date fund. Every piece of that automation is a decision someone else made for you years before silver was at $75. There is a version of this year where nothing changes, silver drifts, gold settles. The target date fund grinds out its steady return, and the gap between your portfolio and what was possible never materializes. That version exists. I am not discounting it. But there is also a version where we are sitting inside a multi-year revaluation of hard assets, where 6 consecutive years of silver supply deficits finally matter, where central bank gold buying at historically elevated levels is a signal, not noise, where the analysts at Goldman and JP Morgan and Wells Fargo and UBS are not making these targets for fun. And in that version, the retirement accounts that hold 0 ounces of anything are not just missing returns. They are missing the trade of the decade while it is happening in plain sight. And that is not even the expensive part. Let me put all the numbers together. Start with $49.1 trillion. That is total U.S. retirement assets. The recommended precious metals allocation from most financial professionals falls between 5 and 10%. Take the low end, 5%. 5% of $49.1 trillion is $2.455 trillion. That is the amount of capital that, by conventional wisdom, should have some exposure to precious metals. The actual amount allocated to physical gold and silver in retirement accounts is a fraction of that figure, a small fraction. $2.455 trillion of recommended exposure, against a backdrop of 6 consecutive supply deficits, against a metal that just posted 143% in 12 months, against gold targets north of 5,000, against a system that makes the default easy and the alternative invisible. One asset class, 1 year, 143%. $49 trillion watching from the sideline. That is not a gap in your knowledge, that is a gap in your architecture.